Hello and welcome to the latest episode of Hardman Co's Private Company Valuation Forum, where we explore the world of private valuations and share market insights with leading experts. I'm Richard Angus. I'm Head of Business Development at Hardman Co, and we are thrilled today to be joined by two highly respected guests. We're welcoming back Doug Lawson from MarktoMarket, and today Veronika Oswald, who is the Commercial Director at Jenkins. So we're going to dive into what is happening in the world of private company valuations after ending a pretty difficult 2024. We're moving into 2025. So one of the things that's causing a massive problem, I think, is that the entrepreneurial spirit in this country is still very much alive. But when it comes to actually finding the finance to support young entrepreneurial companies, it was very, very challenging in 2024. And in 2025, everybody seems to be incredibly busy trying to enable these transactions to take place. But the truth of it is that the investor is still very much in charge of the equation. It's his money. He's got time on his side. He sees quite a lot of special opportunities. And I'm not sure sometimes whether he feels there's any urgency to invest right now. That's quite different from if you were the entrepreneur looking for money. So contrast that with the very different scenarios that we've had when life is much more like blue sky. When companies raise money, the entrepreneur doesn't really have to say too much because the investor gets so excited about the prospect and how much money he's going to make that money becomes fairly quickly available. And also in that environment, no one really thinks about when the next funding round will be required. Everybody thinks, well, in 12 to 18 months, they'll raise more money, but that's not a problem because the money will be available. I will be around, my shares will have gone up, I will be pretty happy, and I really don't have any need for any liquidity because I'm going to hold these shares for a long time. Now, in this particular market we're in now, it's very, very different because if you run out of money as a company, mainly because there's a problem that could or could not be under your control, you get a very, very poor reception from investors. Existing investors feel they've been let down. New investors go, well, why would I want to invest in a company that doesn't really have good financial resources? And it brings the whole thing to a stop. So if you look at this from another point of view, which we do, we say, what is the room risk in a company? What is the running out of money risk? If that running out of money risk is translated into English for investors, it's likely that it will raise their confidence in the underlying story. If suddenly there's an emergency fundraise, it's absolutely catastrophic and values can be completely destroyed. So a lot of this is really all to do with investor confidence and a matter of timing. And you could argue that we are in a very depressed state. Most people do not feel particularly optimistic about the future, but we all know that markets go in cycles. So the point being here is that at some point, investors suddenly believe that actually things are cheap, they are worth investing in, and everybody gets excited again. And we've been through this time and time again. So it's a question of timing. And what I'm really interested in is in two things. The first thing is what is actually happening in the transaction market at the moment? What is actually taking place? And then the second thing that is very interesting is there any underlying liquidity in the shares of the businesses, the companies concerned? And so the great thing about having both guests here today is hopefully we're going to be able to address both those topics in the next 20 minutes. And so Doug, over to you and give us an update on how things are going in the transaction market. Thank you.
Thank you very much, Richard. Thank you to everyone at Hardman. It's a great pleasure to be back on this again. So what I'll do now is I will share my screen. So the basis of what I'd like to talk about is this report, which is the MarktoMarket UK M&A Valuation Indices 2024. We compile these reports based on data submitted by our customers and data that we collect here at MarktoMarket. And MarktoMarket is a financial data platform, and we specialize in data on small and medium-sized businesses. I mean, we cover data on large businesses, but that's relatively straightforward to find. What's difficult to find and what you have to be very forensic about is collecting information on small companies and transactions involving small companies. The reason behind doing these indices is just to take the temperature on the market. Now, what you can do on the MarktoMarket platform itself, I don't want to turn this into a sales pitch, but I think this is important, is you can look at prices paid and multiples paid for specific companies. What these indices do is aggregate all of that transactional information to look at trends in the market. So our valuations trending up, down, sideways. We also slice and dice our indices to give you a feel for how in different categories of the market, different areas of the market, prices are trending, because they might not all be going in the same direction. So if I just take this forward a couple of slides, just as a bit of context here, so we have when we collect the data, both the data that we have that our analysts have collected on market transactions and the data that's been submitted by our customers, we put that data into buckets. And that's sector buckets and size buckets. And the reason that's really important is that so that we can look kind of under the bonnet of general valuation movements and really understand, okay, well, in specific sectors, how are valuations trending? And with particular sizes of businesses, how are valuations trending? And anybody that has followed any stock market indices will kind of understand that they don't all trade. You don't see the FTSE 100 and the FTSE AIM all share following the same performance chart. Those will diverge from time to time because of the underlying constituent companies. Sometimes small companies, for example, AIM companies, are attractive to to investors. Sometimes they're not attractive to investors. And the same applies for large caps. And then within sectors, some sectors may be particularly popular at a point in time or over a longer period of time, and then they may fall out of favor. So that's why we segment this. Now, what this chart is showing here is our sample and how our sample is broken down by what we call super sectors. So you can drill underneath these, but broadly speaking, we have 5 super sectors, which are industrials and business support services, technology, media and telecoms, consumer, healthcare, and financial services. You'll see that the bulk, so about half of the companies within our all cap index, about half our companies fit into this industrials and business support services category. That's maybe not surprising. It's a pretty broad church. Then we have technology, media and telecoms. That tends to trend at about 20% or so. Then we have consumer. What's actually quite interesting about technology, media and telecoms is that the number of deals that have been happening there we're kind of under indexing at the moment. So the volume of deals happening there in proportion to the overall market has gone down in the last couple of years. So about 20% of the deals in our sample would fit into that category. Consumer is similar. That's another 18%. Healthcare is 7%, and financial services is 7%. Now, if you look at the constituents by size band as well, I think this is important context. Now, all other things being equal, a small company will trade at a lower multiple than a larger company, or a small company will be sold for a lower multiple than a large company. And that's all about kind of the risk. People perceive smaller companies to be riskier than larger companies. Now, there may be other reasons why that small company has a higher multiple than the larger company, probably because it has much faster growth. But if everything else is the same, if you take a small company and a large company, they do exactly the same thing. They're growing at the same rates. You will typically find that the small company will be sold for a lower multiple than the larger company. And that's why we show this chart here, which just breaks down in terms of our sample of companies. It breaks down the size buckets that the constituents live in. So if you look on the right-hand side of this chart, you've got 4 size indices that we monitor. The NanoCap index, which is where we collect deal data for companies that have been sold for less than £2.5 million. So really the tiny companies. Microcap, which is companies that have sold for between £2.5 and £10 million. Small cap, which is £10 to £50 million businesses, and mid cap, which is £50 to £250 million businesses. Now, of course, different people have their different definitions of what constitutes a small cap or a mid cap company, but this is the way that we segment. You can see again when you look at our all cap index, about a third of the companies in the index we would classify as microcap, £2.5 to £10 million companies, 28% nano cap, small cap is 25%, and then mid cap is 14%. So that's how that's built up. So in terms of the all cap index itself, in terms of the pricing of the market last year, so looking at 2024 versus previous years, this chart shows the median EBITDA multiple for a business paid in 2024. It shows mean and median. I tend to focus in on the median because obviously it smooths out the impact of outliers. So the median EBITDA multiple paid for a business in 2024 was 6.6 times. And actually that's quite positive news because that's up from 6 times in 2023. Now, these indices are always there's always lots of context around this because unlike, I've referred to stock market indices before, broadly speaking, in a stock market index, you will have the same constituent companies from one period to another. So if you're analyzing performance one year to the next, you are really comparing like for like all the time. It's slightly different here because the businesses that sold in 2024 will be different to the businesses sold in 2023. Having said that, if you think about the previous charts that I've shown, our samples were broadly the same in terms of the sector split of companies and the size split of companies. So I think this is a reasonably good indication of how multiples are tracking. We're still not back to the levels that we saw back in 2021 and to a lesser extent in 2022. So I think it's broadly understood that markets were pretty hot in 2021, both in terms of the volumes of transactions that were happening and the valuations of assets that were changing hands. That carried over to some extent into 2022. However, it was 2022 when interest rates started to go up, and you do see a correlation between rising interest rates and more depressed valuations. I think now that the outlook, the medium to long term outlook for interest rates is looking better in terms of lower rates, you're seeing those multiples start to increase again, valuations start to increase again. So that's the all cap index. The all cap index is up about 10% year on year. So that's all companies sub £250 million enterprise value, EV to EBITDA multiple paid. So a reasonable guide there for the kind of general direction of travel of valuations. I won't go into revenue multiples. I'd rather spend the time looking at the sub indices. So if I move forward here, these are the size indices all plotted on one chart. And what this does is really prove this correlation between size of business and the multiple paid for a business. So you can see this 6.6 times here. So that's from the chart we were looking at before, that's the all cap index. So 6.6 times was the median EBITDA multiple paid in 2024. If you remember, we segment our indices by size. So we have our nano cap index, our micro cap, our small cap, our mid cap, and we have a large cap as well, which is over £250 million deals. And you can see here, as the chart moves from left to right, how those multiples increase. So the second bar here is the nano cap EBITDA multiple. So that was 4 times. The microcap EBITDA multiple was 5.8 times. It was 8 times for small cap, 10.1 times for mid cap, and 13 times for large cap. So again, this is kind of proving this sort of widely understood situation, which is that as businesses get bigger, the multiple that's paid for those businesses will increase. The other bars in this chart represent revenue multiples. So it's broadly the same thing. So you can see here revenue multiples trending from 0.7 times in a nano cap business, the median revenue multiple there, to 2.6 times in a large cap business. Now, if I move on here, this is plotting the discount or premium for size to the all cap index. So in other words, a nano cap company, if you take our nano cap multiple, which if I go back here was 4 times. If you look at our nano cap median multiple relative to the market as a whole, there was a 33% discount for a nano cap company relative to an all cap company. If you move up the chart here, it was a 5% discount for a micro cap company. A small cap company traded at a 43% premium to a nano cap company. So I think these are quite useful, these charts. If you're looking at benchmarking valuations, and you have a bunch of similar companies all doing the same thing, but they're all different sizes, you can make these size adjustments based on this chart here. Now, if we dive into the size indices, so 4 times was the EBITDA multiple paid for a nano cap business. That was broadly in line with the year before. So it remains down on 2021 and 2022. We typically see a bit less volatility at this end of the market, this very, very small end of the market. And I think that's because broader macroeconomic factors tend to be a bit less relevant for these very, very small companies. And I think that typically the buyers of these small companies are less concerned by some of the factors that might inform the decision-making process in large takeover situations. So you tend to find that, you've got this kind of range of 4 to 5 times at this end of the market, and you'll really always find, not always, but you'll typically find our index kind of trading in that 4 to 5 times range. If I move on to microcap, so these are the 2.5 to 10 million pound deal bucket, you'll see that's trended up a bit. So that's positive, of course. We're seeing prices moving up slightly for microcap businesses, but still well off the highs of 2021 and 2022. Now, the small cap index, which is 10 to 50 million, we've actually got multiples compressing a bit there. So we saw 8 times as our median multiple relative to 8.6 times in the year before. But conversely, when we look at our mid-cap index, which is 50 to 250 million pound deals, we've got multiples trending up from 9.8 to 10.1, still well off the levels that we saw in 2021 and 2022, but a positive indicator there. What I think is quite interesting at this end of the market, this is really classic private equity territory, the 50 to 250 million pound deal range. So we see lots of, on the buy side in this market, we see lots of private equity houses. And of course, their ability to pay their pricing is to an extent, certainly for most of them that will be using debt as well as equity to structure their deals. The cost of debt is a key determinant in the prices that they will ultimately pay for assets. So again, it's maybe no surprise there that this chart is correlated with the movement in interest rates. And then we have the large cap index. So large cap companies, the sample sizes get quite small up here. So I think they're a bit less statistically significant, but you can see that sort of trading around about that 13 times. Now, if we just quickly go on to sectors, I'll just show you 3 sectors here. So the 3 sectors that I'll focus in on here are the industrials and business support services sector. Median multiple there was 5.9 times, consumer sector 6.8 times, and TMT 9.5. If we look at the trend, we had industrials and business support services, really nice expansion of multiples there from 5.4 to 5.9. So really good indication of sentiment there. Consumer was flat. Consumer took a real sort of hit in 2020, recovered a bit in 2021, and has been sort of flattish since then. And then if we go to TMT, TMT, again, very positive trend there, from 8.6 times EBITDA in 2023 to 9.5 times EBITDA in 2024. Still way off the highs of 2021, when again the market was extremely hot, especially in this area here. And there's a real correlation when you look at how different sectors are correlated to interest rates. We see that correlation as being particularly strong in technology, which is a sector that typically has higher growth rates. Richard, that's probably all I'd like to say at the moment, if that's okay.
Doug, look, that's fantastic. Thank you very much for those insights. I do have one question for you before you disappear. Given all the data you've provided and the amount of interest, presumably your client base is expanding, and I'd be interested to know where the new levels of interest are coming from. Is it from specific areas of the financial world, or is it from investors? Because that will give us a good insight into where, because I think the level of interest is increasing dramatically. It's just a question of getting to the next step of making a transaction work. So I thought it'd be useful for you to give an insight into that.
Yeah, sure. Actually, I think the kind of, obviously I've focused at the moment on the M&A markets rather than the fundraising markets. So I'll just talk about the M&A markets, if that's okay, Richard. I think what we've seen in terms of buyers in the market for small assets is a lot of private equity money trickling further down the market size spectrum in smaller companies. But sometimes it's not obvious that's happening because that money isn't coming directly into these small companies, but into their portfolio from their portfolio companies. So in other words, a private equity firm will acquire a portfolio company for £50 million. That portfolio company will then do a series acquisitions for £2, £3, £4, £5 million. So the money is ultimately coming from the PE fund, but it's being funneled through the portfolio company. But what that has been doing over the last decade or so is creating this new category of buyers at the SME end of the market, which are the private equity backed portfolio companies. And that's adding, I think people would traditionally feel that that's a very kind of trade dominated territory. So, a slightly larger company buying a slightly smaller company, but now they're competing with these private equity buy and builds for assets down there. You also have search funds appearing as well. So these are some people describe them as the modern version of management buy-in teams. So people that are looking for a company to acquire. You've got employee ownership trusts. So actually you have lots of new categories of buyer down at that SME end of the market. And I think that's really helping liquidity down there. So I would see that as a long-term trend that's going to continue and hopefully continue to improve liquidity at that end of the market.
Doug, that's absolutely fantastic. Thank you very much indeed. Well, I'm now going to move over to Veronika. And hi, Veronika. Thanks very much for joining us. We all know that illiquidity or lack of liquidity for many investors is a pretty tough topic when there's a lack of excitement, or I would say energy in the market, which is probably right now. So I'm sure our viewers will be very interested to hear about your contribution to this area. And I think in particular, as we go through a few questions, what has really changed over the last year, so we can give some indication of the momentum behind the changes. But perhaps you could start off with a very short summary of your business expertise and then describe what JP Jenkins actually does for those people who have not come across you before. And then we'll move into a few questions about your clients and a few other interesting areas. Thank you.
Wonderful, Richard. Thank you, and thank you to Hardman for having me today. That was excellent presentation. I really enjoyed looking at the data. But yes, so JP Jenkins. I'm the commercial director here at JP Jenkins. We are the largest trading venue for unquoted assets. What that basically means, without the fancy jargon, we provide a liquidity. This is on a secondary basis, liquidity to existing shareholders of private companies. So really, it's a venue for companies that have managed to raise money and financing over the years through some of the wonderful schemes that are operating in the UK, like EIS or Angels, but have not actually achieved a full exit or are on a route to a full exit, whether that is an IPO or an M&A type of a transaction. What we are seeing is a trend where there is a capital available to private businesses. They are obviously being supported, whether it's private equity or angels or further investment schemes. But what that means is you now have a lot of shareholders that are locked in to companies, and they don't have a way out. As we often say, everyone is telling you how to invest into companies, but very few people will tell you how you will be able to get out. And that's really our ambition. We are not really deemed as a competitor to the traditional markets. Rather, we position ourselves as a support to really help with making sure that companies that are on that journey of looking for a full exit do have their options open. We trying to encourage companies to naturally stay in UK and continue the journey of staying in UK, not trying to fly to all those rather exotic and wonderful exchanges abroad that promise a lot of liquidity but are also extremely competitive. That's really our role of how we see JP Jenkins and how we're positioning ourselves.
Right, thank you. So there's been quite a big trend recently, I would say, of the companies delisting from markets. And I noticed from the news that you have enrolled quite a few of these companies. They've basically asked for admission to your platform. So maybe you could just talk about the dynamics of that. And in doing so, talk about maybe the size of the company or the sectors or any trends that you might think people would be interested in, and whether these trends are showing signs of peaking or whether they're showing signs of accelerating. And then I'm sure Doug has got a question or two for you.
Excellent. Yes, there has been a trend, especially over the last couple of years, companies not really being able to sustain themselves or not finding the public markets are working for them. And that is really for different and various reasons why they no longer want to be as a public company, where they don't want to operate in those structures. What we have seen over the last couple of years with the increased interest rates and the overall environment, there has not been a huge amount of capital that has been deployed into the markets, and that really starts all the way from the retail to the institutional base. Liquidity being probably one of the main reasons why perhaps some of the larger institutions are not as active as well. And that all acts as a little bit of a perfect storm when it comes to the public exchanges. AIM this year is celebrating its 30th anniversary in June. It's going to be, I think, quite an important year for the junior markets overall. We obviously had the change of government last year. We had a change of conditions when some of the junior markets are being approached, and some of the advantages which they've had has been slashed. I'm talking about the IHT side, where you're obviously losing 50%, where investing into an AIM stocks previously would be exempt. So obviously that is not happening now. And a lot of companies are just finding the cost of capital in the public markets far too expensive. And that is obviously contributing to the lack of IPOs these days. To embark on a journey of an IPO, which my original background is really the capital markets, and I am still very supportive of them, but that is really more suitable for a certain size and type of companies. What we're seeing currently, businesses that are very much in an R&D space and are not perhaps as steady in terms of revenue generation, find life in the public markets rather difficult, because it is all about how you can communicate, but also how you can deliver. So what we believe at JP Jenkins is really nourishing companies that are in that interim growth stage, but are not ready for that traditional public markets environment yet, but providing some of their existing shareholders with an opportunity to be able to liquidate their holdings, but without obviously damaging the market cap or the overall view for the companies. So yes, a lot of exits currently coming out of the typically it would be the AIM market. We have some companies that transitioned from the Aquis market as well. In terms of sectors and valuations, it's quite broad. Obviously, the size of companies on the AIM market is a bit lower than the traditional main listed companies, but notably we have had some large companies that have gone through the journey, and maybe one to mention is a demerger that came out of a listed group that was significant in its size, but a lot of perhaps some of the other joiners were of a kind of a small or micro cap and nano cap size.
Okay, thank you very much. Doug, have you got any questions that?
Yeah, I was curious because I think this is I completely understand the need for liquid. If you look at the amount of private capital that's gone into businesses, especially angel funded or crowd funded businesses that have very long cap tables, lots of people on the cap table who individually are not able to really affect any kind of liquidity event.
Yeah.
So bringing those people together and giving people an option to exit or to stay, I think is something that's definitely needed. What I was wondering about, Veronika, is there some parameters in terms of the business size or the kind of proportion of the cap table that is intended to be trading? Are there kind of minimums that you need to have in order to make this the economics work for you?
Yes, no, that's a very relevant question. When it comes to companies that are joining the venue, especially if they're coming from the public markets, we obviously put a lot of emphasis on longevity, making sure that the companies, when they're coming off the market, that there is a plan post delisting. It's not just a company that is obviously going to put a few nice words out and then just disappear to the world or is about to go under. So there are certain assurances that we really look at rather than looking at we don't have a requirement for a free float since this is only a secondary position. It's not an IPO where there is a certain element of float that is required. So really when it comes to the admission, the companies will be coming to us because they know there is going to be a demand on that secondary side already. What that demand is very often determined, sometimes even 12 months post delisting or post the transitional part, because very often we find people don't notice the announcements or they have not been notified by the brokers, and that often happens with some of the smaller retailers as well. They haven't followed the progress of the company, they missed the announcements, and obviously they now think that the valuation or the shares are now worthless. So this is what we're filling in as a really essential step, and working with a lot of the retail platforms to be able to make sure that we can communicate to those shareholders actively that they haven't lost their money. The company has transitioned, but there is a facility still available to them. So in terms of our due diligence and checks, we do have active monitoring. We put a lot of emphasis on the teams and obviously monitor that balance sheet and making sure that the company is able to continue operating.
Yeah. And can I ask one more question, Richard?
Of course.
How is the price set?
Yes. So in fact, for the companies that are coming off the market, we migrate the last traded price, which is sometimes difficult for the companies because naturally, as soon as they start putting out the announcements, the natural environment, that share price typically comes down quite significantly. And really that is the main objective of JB Jenkins, is really to start working with the company to make sure that we can help them to revalue their business. But initially the price is migrated to us from the regulated exchange, and that's what started them off.
Thank you.
Thank you. And when these companies join you, do they have the same intent to communicate regularly with investors as they would do when they were a public company, or do they think actually, well, there's a private forum here, a liquidity forum, actually we've sort of done what we can and that's basically it? Or do you think they understand the need to constantly make sure their shareholders are happy with whatever they're doing in terms of the communication?
Yes, Richard, it's a mixture. We've got some that are excellent at communications. We've got some that could really do better. And whether the company is private or public, but is on trading venue and does have shareholders, our job is to remind them actively to say that communication with shareholders is not nice to have, it's absolutely necessary. If they're expecting liquidity, if they're expecting people to still be involved with the businesses, they do need to be able to communicate, not just to their own shareholders, but to be able to continue telling their stories and how they're progressing.
And when it comes to the order flow you receive, does it come through intermediaries, private individuals, a mix? And can they just call you to transact? How easy is it?
Yes, and so in terms of our own infrastructure, we operate in the same infrastructure as the public market. So we use the intermediaries as brokers to place orders, and this is really what's helpful in that example of companies coming off the market or transitioning from the market, because there is no interruption in terms of a service. And they're able to use exactly the same brokers, use their same nominee structures to be able to place transactions. They do not call JP Jenkins directly, but they call their brokers, or they place the order with their brokers. And then we do have an electronic venue where the brokers are connected to. Obviously, the difference at this point is there is no market makers, there is no spread. It's a pure much bargain trading with some controls that surround that. So it's a little bit of a safer, less volatile environment where transactions are executing at that one given price as a much bargain. But the same brokers, the same infrastructure, no individuals calling, as not like a crowdfunding setup. And really, we do operate through the regulated counterparties, like the traditional brokers like Hargreaves, Lansdowne, AJFL, all the way to the likes of Charles Stanley, Killick, what have you.
Thank you very much indeed. Well, I think we're basically running out of time. So, Veronika, thank you very much for your thoughts. Thank you very much, Doug. Very good to see you again. We will continue at Hardman Co to track developments in this market. Obviously, it's a very dynamic market, and we're very concerned about keeping our eye on what's happening to valuations and investor confidence. So on behalf of Hardman Co, I would like to thank everybody for viewing today, and hopefully we will see you at the next Private Company Valuation Forum. Thank you very much indeed.